Hello everyone, welcome back to our financial series on interest rate products. We've got Bill Addis here joining us again today. Bill, welcome back.
Pleasure to be here, thank you.
Now, in our previous sessions, we talked about some of the different categories in the bond markets and interest rates. Now, one of the ones you and I talked about earlier was collateralized debt obligations or collateralized loan obligations. Right. Walk our viewers through that asset class and how it works.
And a CLO really warrants some attention in today's market. It's a collateralized loan obligation. And I would ask the viewers to keep in the back of their minds what they might know about the mortgage market, because this model is somewhat akin to what happened with the mortgage industry.
Okay, good.
But banks are in the business of making loans. So the banks make loans to corporations. We're not dealing with the individual investor here. These are commercial loans. So the bank is making the loan to the corporation, but then what the bank is doing is they're taking their loan portfolios and they're literally selling it into their own trust account. This is just a legal subsidiary.
Okay.
It's an accounting issue, but they move it into this trust account called a special purpose vehicle.
Right.
And now this SPV is sitting with those assets being the loans on the books. Then this SPV issues bonds. So the investor in the bond is actually taking on the credit risk of the loan portfolio. Just like in the world of the mortgage crisis, the investors in those bonds were buying bonds that were backed by individual mortgages. In this case, it's backed by commercial loans, but the idea of it being a credit product is very much the same.
So in this visual here, you can see up at the top, we've got a bunch of different loans. They come in all different shapes and sizes. And what you're telling us is that the bank will take those loans, put them in what's called the special purpose vehicle or SPV, and then from there they're kind of categorized into different subgroupings. So it could be AAA rated, BB, BBB, and then equity.
Correct, and we can structure these bonds to meet a variety of different needs. We do what's called credit enhancements to literally create some pretty high quality bonds. As the illustration mentions here, we've got some AAA rated bonds came out of this.
Which is the good stuff.
Well, that's the high quality stuff, the lower yielding stuff,
right,
because they're taking the less amount of risk. Then the other tranches, the other maturities, take a greater amount of risk, and therefore they're going to pay higher rate of interest because you're taking a higher rate of higher risk. But the AAA stuff is kind of at the base. That's the foundation. That's the highest quality. And what I'd like you to think about the idea of pooled aggregated risk. You know, don't think of it like, gee, this must be a good loan to a good business, so it backs the AAA bond. Or this is a poor quality loan to a poor quality company, it backs the single B. Think of it as pooled aggregated risk. The aggregate amount of risk coming out of this trust is equal to the aggregate amount going in. We just re-engineered it. So the bond investors who have the AAA rated bonds, they're going to get the money back first.
Right.
So any deterioration shouldn't be experienced by them. It's going to be experienced by the lower quality as you go further up the list.
Right. And visually, I think this is a good aid to help you understand what we're talking about here. You kind of can see this hierarchy of asset-backed securities, and down at the bottom there, which is actually the best, is the ones who are paid first. That's AAA, meaning that your risk is the lowest with AAA.
Right.
And generally, it's not like your cut of meat, where the prime cut is the one you pay the most for. Here, the prime cut in the bond markets, you get paid the least for because it's the least amount of risk. But on the flip side, there's a return to risk kind of ratio, or reward to risk ratio that we like to follow. You'll notice the return here, it's much higher if you're in the equity, because the equity could be the one who's paid last, and they may not get paid. So should this company default on its debt, those down there in the AAA, they're going to get paid first. Therefore, it has a lower return, but much lower risk. So as individuals or corporations' appetite for risk goes, you'll move higher up this ladder to finally we get to the equity markets, which are the highest risk.
Perfect explanation. But I also want to add, the issue that's going on presently is that the banks, because of this structure, the banks are able to pass the risk on to their investors, the bond investors. The banks have been more and more willing to lend lower quality loans out into the marketplace. We call these covenant light loans, where there's not a lot of terms and restrictions to it. And the reason it's covenant light, quite frankly, is because a lot of times these corporations couldn't meet those terms and conditions.
Right.
So the banks are making these lesser quality loans to corporations with the knowledge that through this structure, they can pass that risk on to investors. So we just want to lend a cautionary note. With now 85% of the loan market now being these light loans, not having the covenants we're used to, that's putting a lot more credit risk in the market.
You know, an interesting way to look at this is many of you might have been involved in the housing market crisis of 2008, and you had a mortgage, and all of a sudden you realize, oh, I can't make the payments on my mortgage because I lost my job, I don't have the income anymore. And you're looking at this right now going, well, this is all fine and dandy and interesting, but it doesn't really impact me. Well, that's not true, because if you are holding investments in your 401k or your IRA, they may be actually buying these CLOs or CDOs in that portfolio to help them generate a rate of return that you've been enjoying. So what happens if they can no longer make that debt obligation or they start to default on these loans? Yes, it could significantly impact you in the long run because these aren't retail packages they were looking at. These are businesses and institutions buying these collateralized debt obligations to help their portfolio maybe keep in a locked rate of return. But now this lowering of ratings adds a big element of risk, a question mark to the whole industry.
It does. It does, and it's one that we're really putting a cautionary note out there because right now, 50% of the corporate bond market, and these are technically a type of corporate bonds, are made up of BBB rated bonds, meaning they're at the cusp of a potential downgrade, and that's 50% of the market. Now, if you go back to 2008, only 28% of the market was in those most perilous BBB.
So we got from 28 to over 50%.
Over 50%. So there's a lot more credit risk in the market, and as you're pointing out, you might not know that you own these bonds yourself, but through your ETFs or through your open-ended mutual funds. So I just want to add a cautionary note of be aware of what's going on out there. There's a lot of credit deterioration being experienced in these products.
You know, as we talk about the rating here and as they're starting to drop, so it's no longer AAA paper, which is the creme de la creme, then it's talking triple B. If we start to decline further, you talked about junk bond markets for a while. It has a negative connotation. Of course, here in Southern California, we had a wonderful junk bond crisis many years ago. But junk bonds are just something that pays a very high yield, right?
Correct. A junk bond is simply a corporation of lower credit quality that has to pay a higher rate of interest to borrow that money. But junk also has a legal definition. Pardon me. We have a fiduciary responsibility. If you're managing money for a trust account or for pension or for children, you legally cannot invest in junk.
Really? So, so there literally is a rating cutoff.
Absolutely. Anything that is BAA, BBB or higher is what we call investment grade, looking at this chart here. So the BBB paper or higher, lower in this case, is investment grade. Anything lower than BB is what we call a junk bond, but the universe of investors who can legally buy junk is not as large.
Well, and as you're seeing the level increase, you mentioned over 50% now, it's actually starting to pose a problem because now these institutions that might be under those restrictions are going to have to look elsewhere to make investments because now all the stuff I'm trying to buy is junk.
That's exactly right, and that's at the precipitous point that we're at right now. Interest rates are nice and low. The economy's been chugging along. We've had this debt bubble building up. Corporations are more willing to borrow money. That's not to say interest rates are going to remain low. And that's not to say the economy is not going to stay as strong as it was. So this is the most perilous part of the market. Unfortunately, it's the biggest part of the market as we sit here today.
It's a huge part of it, and guys, it's an opportunity out there. It's all about information. Bill Addis has been sharing with us some information about CDOs and CLOs. Now, again, you may not think that this is a direct impact to you in your personal investments like 2008 was with subprime lending and all that, but the portfolio that you have in your 401k may have some of these positions in it, and it's just kind of an important point for us to make sure that you understand what it is that you're buying and know what the warning signs are for the market. If you'd like to learn how to prosper in this market environment, I'd encourage you to click on that link below for more information.